record. Okay, so today what we're going to do is we're going to continue our path on the conversation around long-term care type solutions. So as we all know, there is a gray wave going on in the United States. We have a lot of people who are getting older, which is going to lead to the need to have this conversation more and more. So we talked 3 weeks ago on living benefits. Carriers who have living benefits, ABRs, those discounted riders that are built in that I like to call a safety parachute. So if worst case scenario, stuff hits the fan, you can accelerate it, cash out your death benefit for cash in hand, and that's your living benefits. Last 2 weeks ago, we talked about long-term care, the actual traditional version of long-term care. Some people still like it. Some of the benefits behind it, the government spend down protection that you have with traditional long-term care that you don't have with these hybrid type products is an advantage to long-term care. But nonetheless, we're seeing a tremendous shift from the long-term care side to these different types of products. When we talk about different types of products, it's the ones with the ABRs that we talked about a few weeks ago. It's the ones with this hybrid that we're going to talk about. And then next week, we're going to talk about LTC and chronic illness riders on life insurance. It'll put a bow on all of the products in general, because of the fact that they have, we talked about the basics and we're going to progress up and then we'll compare and contrast them. And I say next week, but I know I'm going to be going down to Orlando. So next week, I'll probably have my marketing team come in and do a presentation. And then the week after, I'll wrap up the LTC stuff. So just wanted to give fair warning in advance. So when you talk about the hybrid life and LTC products, when we think about some of the questions we always ask before we even get started, these are the questions I always like to ask. I asked them last time as well. Have you had a personal experience? We sell from the heart. This is a emotional business. It is not a business that is, run by just numbers. There is emotion to it. So I've done presentations before talking about long-term care, and you see someone actually crying in the crowd because they've witnessed something very similar. So oftentimes when we think about it, we have to ask ourselves, has there been a personal experience? Who is the patient? Who is the caregiver? And what was the impact on the family's health? Who paid for that type of care? And did it impact the finances of the customer, the friend, whoever it may be? Once again, stories sell, and that's what we really want to talk about. So talking about these personal experiences, I had one with my own grandmother that I'll spare the waterworks today, but it was a tough one, to say the least. But we look at things that would impact someone with long-term care or chronic illness, the main one being the activities of daily living. So when we think about ADLs, activities of daily living, someone cannot perform 2 out of 6 activities of daily living. Bathing, eating, dressing, toileting, transferring incontinence. Those are the things that we often find are the reasons why someone needs some type of care. Another big one is cognitive impairments, things like Alzheimer's, dementia, and Parkinson's. And what we really just need to have someone diagnosed to have these type of illnesses is a 90-day licensed by a certified doctor that the client has these type of ailments, and then they can qualify for either temporary or permanent long-term care or chronic illness coverage. So those are usually the designations or needs for long-term care, 2 out of 6 ADLs, cognitive impairments. And we often ask the question, who will care for you? So this is a very delicate question, especially when you're talking with elderly if you're talking even with your parents, for example's sake, who will care for you? Are you planning on having to rely on a family member for assistance? That's always a fun question. Like my dad, he said to me, he's like, Phil, you're my emergency system. I said, like, hell I am. I'm talking to you today about this stuff, so you're prepared and ready, as opposed to me, because I'm not doing certain things that I would never want to do with my family. I want to make sure the family dynamic stays the same. But oftentimes, when you ask this question, are you relying on a family member? The big question is do they know this? At the end of the day, we always want to make sure that we are planning appropriately. And if the family member is okay leaving the workforce to take care of their parents, if they're okay having to do things like help their parents into the bathroom and out of the bathroom, into the shower, that's on them. That's not something I ever want to see. So that's why we plan in advance when we can. Who's going to care for you? Is it a family member? Children, like I said before, can they lift you out of the chair, the bed, bathtub? These are certain things that we have to think about in advance. And does your family members currently live near you? Or do they live in another state or another country? Those are often questions that need to be asked as well. So today, when we talk about hybrid long-term care and life insurance, if you'll notice that I specifically put LTC first, because the designation for this, as opposed to when we talk about the life insurance with chronic illness or long-term care riders, the emphasis will be flipped. So in this scenario, long-term care with life sprinkled into it is really what it is, which kind of steals my thunder for the next one. But different options we'll look at, and then I'll show you an example too of how these things work. So hybrid life, long-term care life. The idea spawned really in the early 2000s or mid 2000s when long-term care is becoming more and more expensive. One of the biggest companies to sell long-term care was Genworth. Genworth was running into some financial issues because they were selling a ton of long-term care. They were the industry leader in long-term care. The problem is they sold too much long-term care, assuming that they'd have a 10% lapse rate. They had less than 1% lapse rate. So insurance companies had to think of different ways where they could stay profitable, beneficial as well for the consumer. And so these never money concepts came up with financial advisors. Financial advisors typically want to keep assets under management. They want to spend less on insurance and more on assets under management because that's how they make their money. And so when you look at the idea of this never money scenario, it was the idea of taking money that is what we call idle assets. Maybe someone was thinking that they're just going to pay for long-term care out of pocket and using some of this never money to become an active asset for the consumer. So it really found its way, and I'll show you the originator here in just a little bit. But the never money concept is what really started to spawn this hybrid long-term care life vehicle. There are some liquidity options. That's what made it extremely palatable. You had some liquidity options that if you didn't like the policy after a couple of years, you could cancel it and get some or all of your money back, depending on the type of product. It's a simplified app. So the application process was usually like 10 questions or a phone interview. Could that lead to a lot of knockouts? Potentially. But it was a way that, once again, originally designed for financial advisors was to get it in, get it out, get it done with, so they could check off on their financial needs analysis that long-term care was covered. These are reimbursement or indemnity products, receipts, or cash. There is a constant fight between which one is better. We'll look at the options. Oftentimes, you'll see that these are kind of like high deductible plans, and that would be like your single pay options. I'll show you why that is the reason why I'm saying that. And then you have a death benefit attached to it too. So it does have some form of death benefit that's attached to the design. So if you don't use it, you don't lose it. So let's kind of explore first the reimbursement or indemnity piece, because this is at the height of any type of long-term care conversation. Now, most people will look at this from the benefit of cash in hand, cash indemnity seems to be the better way to go. Why is that? 100% of the monthly maximum is going to be paid to you in cash. Versus on the other side, they say limited to actual expenses incurred. So if, for example's sake, my bucket was $5,000 a month, on the cash side, I'm getting $5,000 a month. On the other side, what if I had a reimbursement or a receipt that's required to get reimbursement? I have to submit the receipt and then I get however much money back. So it might be 2,500. It might be 3,000. So it's going to be potentially less than the monthly maximum that you're going to get with the cash benefit. That's really where the big fight is receipts versus no receipts, limited versus maximum cash payout. They say unlicensed informal care you can't use. That has changed over the industry and has allowed for more unlicensed help or different types of health. Maybe not a nurse or a doctor, but it might be a chiropractor or someone who doesn't really practice traditional medicine, so stuff like that has changed a little bit. So when we think about this, though, couple things. So on the cash side, if I'm getting paid 100% of the monthly maximum every single month, and then I use it all, but maybe I'm not using it entirely for what it's needed for. Maybe I'm, as I joked in the past, going to Vegas, putting some money on black and letting it ride. People can technically do that with this cash in hand. So could it be that a client could potentially outlive all of their long-term care benefit before they actually pass because they actually use that money frivolously? That is an option. Now, here's the other thing. When you talk about cash in hand, again, cash is king. Everyone loves cash in hand. But what if you become cognitively impaired? Now, typically on the reimbursement side, what you'll find is that the insurance company will work with the care coordinators that are built in to help the consumer ease the burden of collecting receipts. The care coordinator will collect the receipts. So if, for example's sake, you have someone who is, Alzheimer's, dementia, things like that, where they don't know what would happen if a check came in their bank account or not, now you have a situation where the reimbursement might make more sense. So once again, there's no right or wrong answer. You have accessibility to both. But the fact is that you have accessibility to both, but it's easier to let the client decide. That way you're presenting the facts and then they go from there. If you find that you're tending to sell more and be pushy, typically, a client will feel like maybe down the road, they didn't like the option that you gave them and it comes back at you. So that's why I like the idea of educating, providing value, maybe showing a couple quotes, and then figuring out which way they want to go. So what's covered with these type of riders? Pretty much everything. So adult daycare. I always laughed at adult daycare. I was like, dude, is it like school where, they get to go play kickball and things like that? You go bring your adult to, a certain place. But, in essence, it's a good place for people who need help, but also, some people still have to work. Are you going to sacrifice your job to stay home with that person, or do you have to go out and make a paycheck? So adult daycare is pretty much that. It's like daycare but in a different manner. Assisted living, so they're actually living in said location or they're bedridden. Caregiver training, home health care, all this stuff is covered when it comes to long-term care. Maybe home modifications or home improvements. household services, informal care on the cash side, skilled nursing home care, because a lot of people want to go and stay at home before they ever go to a nursing home. So we always start at the homestead first. And there's different types of options. There's single life with a couple's discount, and some carriers even have joint life. So, excuse me, depending on the carrier you choose, depending on the typical client that you have, all of these can change the opportunity. Single life versus single life with couples discount. Single life with couples discount is going to be more cost advantageous for the consumer because of the fact that most of the times when you have a husband and a wife, or spouses, I should say, when one of them goes on claim, typically instead of paying for it, the other spouse will take care of them. So it puts a less of a drag or gives more alleviation to the insurance company that they don't have to pay out the claim quite as fast as opposed to someone who's just a single person. Joint life would be almost like two people can go on claim at the same time. But what I would say is you always need to substantiate what you're going to offer someone with facts and data. And so I am putting the website up there for you to see. It is genworth.com/cost of care. This is a fantastic website. It is free. And it'll tell you based on location how much your cost of care is, at home currently. And also you can drag this up however many years. So if you're talking to someone who's say 50 and you think they're going to use it at 80, well, 30 years from now, do you have per month $13,000 or $23,000 for a private nursing home? These are all real situations. Now, the cool thing about this too, just to show you, is you can base it on location. So not all places are the same. And so if I looked at Nashville, Tennessee, there's different areas that they're looking at. You'll see the numbers have changed. And so I can drag it up 30 years. And so it's actually even more expensive here as opposed to the national average. So just kind of understanding again where your clients are, using this free tool at your fingertips to help you substantiate the conversation. It's a great way to go about it. So once again, genworth.com/cost of care. I would just bookmark it in your phone, on your laptop, wherever it may be. And here's an example that I'll show you. What we did here was we took a 60-year-old female, okay? And here's the thing that they're looking at. So this is the story. Miss Client, if you invest $100,000 today, at any point in time, if you never want this policy, you can get back 70% of what you've invested. So you have an exit strategy if you really need it. If you never use it, we'll also give you a death benefit, $143,519. So if you don't use it, you don't lose it. If you need cash, you have cash. But this $100,000 is going to leverage and give you $464,000 bucket right off the bat. That's almost a 5-to-1 dollar ratio in long-term care right off the bat. That breaks down to starting at about $6,000 monthly. And if you don't need it, as you can see, we put an inflation rider on here and it's compounding. So you'll have almost $10,000 by the age of 79. So when you look at this design, when you look at this setup, it looks fantastic. Your client has a growing long-term care bucket that they can choose to use when they need it. It can be temporary or permanent. But this is where I mentioned before, it's kind of like a high deductible plan. Now, if you'll see 71,000 in the first year, you're probably not going to use 71,000 in the first year because we probably won't use it right away. But let's say we go down and at say 79, you have $125,000. Okay. Well, the first 100,000 is really what you put into the policy. So $100,000 is going to take up pretty much your first year. Now, us males, sorry guys on the horn today, we usually don't last past a year. If we do, the average male who needs some type of long-term care is about 2 years. So really what you're playing with is house money to start. Ladies, you do live longer. Congratulations. Unfortunately, that means, it costs more for you guys when it comes to long-term care, with like riders and things like that, which we'll look at later on. But the reason is you live longer. You have about 4 year horizon when it comes to long-term care. So that would make a lot of sense that, if you look now, there's 813,000 here on a $100,000 investment. So it makes more sense especially for women. So if you're having a situation, argument, conversation with a couple, and they're like, well, we can't do 100,000 for each of us, then you could either do 50-50, or you could do 100,000 on the misses if they're really contemplating it. So this is a single pay. We can do monthly, yearly premiums with some carriers, like an all pay. There are some carriers where it's just a 10 pay. So there are different options. I'm just showing you the one that was most commonly used. And for the question in the chat, yes, you can sell this to yourself. You can buy this for your own need. Statistically speaking, the older you get, the harder it is to get, because more aches and pains and things like that. Just remember, a lot of these are more based on morbidity versus mortality. So when you talk about morbidity versus mortality, they look at different things, like, are you going to have a bigger opportunity for claim versus death? So that's one of the main reasons why when you see these conversations, someone might get a preferred best with a life insurance policy. They might get a standard with long-term care because they might have a higher ratio for one versus the other, or vice versa. So you can see that quite often. Now, this product is the originator. This is Lincoln MoneyGuard. This is actually available for you to run with your clients in a very easy manner. This is a link that I'm going to put in the chat that you can go to. You do not have to be registered with Lincoln to use this. So you see it's professionals. And if I scroll down here, all the way down to the Catalyst tool, I can hit Get Started. And then I can explore the tool. Let's say, yes, I am a financial professional and I am in Tennessee. And I don't need to put my email, but I can hit submit. And it's going to start asking some questions. So how old am I? Let's just say I'm 50. I'm not. And I'm looking at home health care from a cost perspective. My client anticipates needing home health care assistance 8 hours a day, 7 days a week, every year. And my client would also like an annual cost of increase of 5%. We could do 3%. And then from that standpoint, we move on to the next step. Let's just say, well, I am a male and I'm married. Next step, we're going to go with fixed because we can't sell market driven. That's your VULs. We'll do annual for this example, so you can see a difference versus one time. And how long do I want to fund for? Let's just say 10 years. Enter the funding amount. I'll just say 20,000 per year, or a total of 200K, 3% inflation, and we'll hit calculate. So once again, it's pretty pictures that sell versus actually having, ledgers and charts. As you can see here, the purple line is the inflation. It's the growth of my long-term care bucket. And these are the dashes are projected care for home health care as we move along. So this 200,000 would equip me perfectly uh, to cover home health care. Now, if I went back and did qualified care, like say, for example's sake, a nursing home, it might be a little different. If you want to see a ledger, you can just click ledger and it'll show you the values of what I put in, the total amount of long-term care, compounding, 3% interest, and then all the way down to the 20 years, you'll see here I have 22,000. So this is a pretty solid foundation for long-term care. And once again, these are designed to be more of um, your I guess you would say, quick type of sales. Once again, there's simplified apps. If you have clients who have some ailments or issues, they might not qualify for this, but we have several carriers that can go into the mix here. But this is just an example of some of the opportunities that you have at your fingertips. So we here always like to look at the different options, the different ideas to help the client. And this is just another avenue to help you be that financial professional. So life insurance, long-term care, disability, annuities, we got it all. And this is just another feature for you. I'll go on and say right now that I know next week, because I'll be traveling to Orlando, I leave on Thursday. I will either cancel next week, or you'll see something from my marketing team where they will pick up the slack and offer some value. And then at that point, we will carry out the last presentation that we have coming up in 2 weeks, which will be life insurance with long-term care riders. But to put a bow on this, it's time for action. What I would say is look for people who are probably 40 plus. You typically don't offer this to 20 or 30-year-olds. Have idle assets. So if you want to try and move some money off the sideline into an opportunity, I actually talked to a guy who's worth about $30 million. And I asked him, because he said he already had his estate planning done. I said, well, how about your long-term care? He says, I have 400,000 put away into a savings account that I'll use for long-term care if I need it. I said, well, if I could give you the same $400,000 benefit and you could spend less for it, maybe shift the risk or hedge your dollars to get 3 for 1 for your dollar, would that make sense? Said, yeah. So we looked at an opportunity for 150,000 to move it over into a life insurance policy with the long-term care feature. And that gave him a $400,000 bucket to start. Now he has another 250,000 that's going back into something that he could now spend. So people with idle assets, or they're putting it aside saying they're going to self-fund, they're all set with their retirement goals. So they are already good for retirement standards. Now, the worst thing is when you're all set for your retirement and you don't have long-term care, this is a killer for any type of portfolio from that standpoint. And once again, people close to retirement, you always want to analyze to make sure that they have everything set and ready to go. So once again, this is just another tool, another vehicle that you have at your fingertips to ultimately help your clients. And what I would say is it's time to take action, because these aren't going to sell themselves, one. And two, the big thing about sales is we like to solve problems we didn't know we had. And that's the big thing, is we have to uncover these and share with people, these type of situations. So I'm going to pause, or I'm going to stop the recording, and then I'm going to answer the question here.